The stock market has been a roller coaster this year. So far, we're about to head into March and the S&P 500 is down almost 10%. The Dow Jones is down 2,500 points and the tech-focused Nasdaq 100 has lost nearly 15%. So what does this mean for investors? Well, with all the political and economic drama going on right now, investing in dividend equities is one of the safest strategies because it ensures that investors get paid even during rocky and volatile market conditions. In this video, we'll go over the best 5 dividend stocks to invest in, so let's get started. The first one on this list is the Arbor Realty Trust, or ABR, with a dividend yield of 8%. ABR is a real estate investment trust, or REIT, which is basically a company that holds multiple real estate properties that generate rental income, and part of that income is passed on to the shareholders in the form of dividends. With a track record of 9 years, ABR has consistently provided quarterly dividend payments and increased its dividend payout as well. The stock price has also seen a steady growth over the past 5 years, and they have consistently beat earnings estimate over the last 2 years. So invest in ABR if you want a quarterly cash flow from real estate-based investment. The second one on this list is the Globalx S&P 500 Covered Call ETF, or Xyld, with a dividend yield of 12%. This ETF tracks an index of S&P 500 stocks and sells 1 month at-the-money call options for each stock. If you don't know what selling covered calls is, then it's basically an options trading strategy that lets you generate income by selling contracts against the shares that you own. So if you own 100 shares of Apple, then you can potentially make $600 to $1,000 per month by selling call options. And that's exactly what this ETF does. The premiums they collect by selling the contracts is then passed on to shareholders as dividends. And the best part about XYLD's 12% dividend is that it's paid monthly. This means that if you invest $10,000, you get paid $100 every month. This ETF has a track record of paying dividends consistently since 2013, which is quite good. But keep in mind, there's a catch to owning this ETF because the value of this ETF doesn't really move much. In the last 10 years, the price has gained about 15%. So if you're in it for the long term and want consistent monthly cash flow, then XYLD is a good option. The third one on this list is Pfizer, or PFE, with a dividend yield of 3.5%. Now, you might have known of Pfizer as this company who was the first one to get its COVID vaccine approved in the US. But many people don't know that Pfizer is actually a multinational pharma and biotech company that was founded in 1849. That was 173 years ago. Pfizer develops vaccines and medicines in numerous areas and has blockbuster drugs that generate more than $1 billion in annual revenue. Pfizer has a 12-year track record of consistently increasing its payouts. Its 3.5% dividend yield may not seem like much, but compared to many other dividend stocks, Pfizer stands out because it has a market cap of $260 billion and a very low PE ratio of 11.94. Its 5-year growth of 44% is quite impressive for the company its age and size. So if you're looking for a reliable stock with upside potential and a solid dividend yield, then Pfizer is a good option for you. The fourth one on this list is WP Carry, or WPC, with a dividend yield of 5.5%. WPC is a real estate investment trust and operates through 2 segments, real estate ownership and investment management. What's interesting about WP Carry is that they invest in recession-proof properties, which include government offices, self-storage spaces, and schools. They currently hold over 1,300 net lease properties and collect $1.2 billion in rent annually. Their weighted average lease term is 10 years, and they have a 98% occupancy, which means that their properties will make them income for many years. The stock price hasn't recovered from its pre-pandemic highs, but it is steadily growing and has gained about 13% in the last year. If you're looking for a real estate-based dividend stock that is sustainable with low volatility, then WPC is the right REIT for you. The fifth and final one on this list is the Jpmorgan Equity Premium Income ETF, or JEPI, with a dividend yield of 8.8%. They invest in large cap stocks and equity-linked notes, or ELNs, which is an investment product that combines a fixed income investment with additional returns tied to the performance of those equities. In simpler terms, this fund seeks to provide similar returns as the S&P 500, but with less volatility and monthly income. This fund is new compared to the other securities mentioned earlier, with an inception date of May 2020. So there isn't much historical data available, but this fund has a consistent growth of 20% over the last 2 years. Its top holdings include corporate bonds, derivative securities, and companies like Progressive and MasterCard. So if you want a low volatility fund that pays monthly and has upside potential, then JEPI is the right fund for you. So let's summarize real quick. If you want a real estate-based investment, you can choose Arbor Realty Trust, which provides an 8% dividend yield, or WP Carry, which provides a 5.5% dividend yield. If you're looking for a monthly income, then you can go with the Globalx Covered Call ETF, which provides a 12% dividend yield. But if XYLD is too risky for you, then you can go with the Jpmorgan's Equity Premium Income ETF, which also pays on a monthly basis and has an 8.8% dividend yield. And finally, if you want to invest in a well-established company that has a lot of upside to grow, then invest in Pfizer, which provides a stable 3.5% dividend yield. If you like this video, I'm sure you'll like our previous one in which we talked about the best ETFs to invest for this year's volatile market. So please check it out. These videos take a lot of time and effort, so we'd really appreciate your support if you could hit the like button for the YouTube algorithm. Thanks for watching, and don't forget to subscribe for more videos like this.